Good afternoon, viewers. For those who haven't met, my name is Greg Rawlins, and it's a pleasure to invite you to the official listing date of the Reitway Global Property Income Prescient ETF, which was listed on the JSE this morning at 9 o'clock. It is our fifth global property ETF that we have listed on the JSE, and I invite you to participate in a question and answer session. At the end of it, the presentation hopefully will be short and sweet, and I will attempt to answer your questions at the end of the presentation. I want to start off with our guiding principle, which, besides adapting to a changing market environment, changing investor needs, we are innovative in creating a product range of now 9 holdings. Four of them are traditional actively managed collective investment schemes, and now our fifth ETF, which is our first foray into the income environment. All the other 8 are total return orientated. And finally, in our genetics, it's about enhancements. We are constantly enhancing our products, and even our passive products, we are enhancing the indices that they track. But the overall guiding principle is that we acknowledge passive and embrace the active investment styles. We are agnostic. We do not try and promote one investment style over the other, but rather to provide you, the investor, with a range, an array of products to address your allocation to property in your portfolios. And this agnosticism goes beyond just the investment style, but also the investment vehicles. To us, an ETF is just another conduit to a portfolio, and to that effect, we were one of the first to list an actively managed ETF in the form of our actively managed ETF with a code RWAGP. And it's simply just another conduit to the same portfolio that you would find in our 4 traditional collective investment schemes. In addition, we have 3 passive ETFs that track customized indexes, and their objective is to extract certain elements out of the global property universe, but with one objective, and that is to outperform acceptable benchmarks after costs. Put shortly, our ETF that comes with the index RWGPR is a concentrated high performance index, but it comes with a degree of volatility. If that is not what you are looking for, we have our diversified index, which comes with a broader selection and still outperforms benchmarks, although to a low degree than the GPR above it, and its stock code is RWDVF. Further, and our third actively managed, our third passively managed ETF prior to today's listing is RWESG, and that is to address the requirements of investors who need to or who are conscious of ESG in their investing portfolios. But today is all about the income ETF, namely the Reitway Global Property Income Prescient ETF, the JSE stock code being RWINC. I caution before we go any further, this is not the panacea to all your income requirements. However, I believe that it should be a noticeable element in any income portfolio and deserves an allocation in excess of at least 5%, if not 10%. The index that the ETF tracks is derived from a universe created by Global Property Research, our partners domiciled in Amsterdam, who advocate the need for market liquidity in all the indices they create. It's absolutely vital to consider liquidity, because one of the hallmarks of most high yield investments is a low liquidity. So it is an investment that you can enter in on a daily basis and exit without much consideration having to be applied to the actual liquidity of the investment. It is calculated and maintained by Selective, the holding company domiciled in Frankfurt, the holding company that is of Global Property Research in Amsterdam, and Selective is one of the largest index providers. So ultimately, the creation of the index that the ETF tracks has been a collaboration over at least 9 months between Global Property Research, Selective, and us here, Reitway Global in Cape Town. The aim of the customized Reitway Global Property Index, and effectively that of the ETF, is to deliver a higher immediate yield whilst mitigating capital loss relative to the global property sector's market movements. We cannot, and nobody really can, guarantee a capital loss in considering market movements, taking into account market movements. But you'll see when we get into the detail of how the index is calculated, we have taken many steps to mitigate capital loss relative to the global property sector's market movements. So getting into a bit more detail, we have 4 buckets. The first 2 buckets consist of oversold REITs, and it's a portfolio of 12 US REITs that are oversold. And the second bucket is made up of REITs that are non-US, and they combine to ensure that there's an adequate overall market allocation to the global property. The problem is that the US makes up a significant portion of the global market capitalization, and many indexes tend to have an overweight, an unhealthy overweight, that is, to the US, and we ensure that there's adequate diversification. One of the steps that we take to mitigate capital loss relative to the market movements. So what is oversold REITs? Well, there's a technical explanation, and that is a REIT is considered oversold if its relative strength index is below 30. This suggests selling pressure has been excessive and may be due for a reversal. So it's 2 potential examples of where this could occur. The first one is sentiment. It's quite simply put is that widespread panic may cause stock prices to drop below fair value. And the second potential example is corporate action. That is where the market may take an overly negative view to a transaction, creating a short-term rise in yield. That is the REIT yield. More specifically, an example of this would be when a REIT puts in a bid to acquire another REIT. Invariably, it is the acquirer that suffers a significant decline, anywhere between 3 to sometimes even 10%, creating a high yield as a result of this corporate action. But what really belies us is that the fundamental aspect of REITs is that they continue to deliver stable dividends despite adverse economic conditions. Adverse economic conditions, together with these examples of sentiment and corporate action, it's unlikely in many cases, or very seldom, do REITs decrease their dividends. So if these cause declines in the price, in the market value of a particular REIT, it creates an opportunity for us to reap that higher yield. The third bucket also making up 40% of the overall allocation, is simply the 12 highest yielding REITs in the universe of global REITs. And it's also screened to take out those REITs that are terminally damaged. We don't want to have that in our portfolio. Finally, the fourth bucket is made up of global REIT ETFs, and we see it as an anchoring bucket. That is to anchor it as close as possible, or help towards anchoring it towards the global REIT sector, so that we do not create too much negative decreases should the market, overall global REIT market decrease. So this fourth bucket is made up of 6 at this present REITs. That is the iShare, not REITs, the global REIT ETFs, and that is made up of the iShares, the S&P, and the FUNEC global REIT ETFs. This was selected from a universe of more than 20 global REITs, global REIT ETFs. The next 3 may come as a surprise to you, but no surprise to us, because the design of our existing total return ETFs is to outperform recognized indices. And these 6 ETFs, current ETFs, are there to anchor the overall performance relative to the market. But it's all about yield. So in this table, what we have done is display the income index relative to a total return index, its actual dividends that were delivered. And in 2015, you can see our income index delivered a 5.79% yield. By the way, this is as a result of back testing, whereas a total return index, as per the Global Property 250 REIT Index, delivered 4.6% in dollars, 4.06%, a difference of 1.73%. This was made, these figures were extracted, made under the assumption that an investor invested on the 1st of January each year and wanted to see what the dividend yield was at the end of 31st of December. And we carried on this exercise through to 2024. And as you can see, a number of years actually exceeded the excess was more than 2%, and in a couple of years, 3%. The average yield for this period was close to, for the income index, was close to 6.7% in US dollars, whereas if you were investing in a total return, high capital growth, lower initial dividend, you would have received 4.33%. An average annual difference of 2.36%, or a yield enhancement in excess of 50%. Now, I have cautioned already that in income investment vehicles, particularly if they're high yield, you'll get significant capital movement. So what we have done is extracted in that same period the capital movements of the index relative to the benchmark. And as you can see, 2015, it was negative 10%, and the benchmark came in with 2.18%, a noticeable difference of 12.18%. But have a look at what happened in 2020, and that was the beginning of COVID. And the income index dropped significantly relative to the benchmark. The difference was 12%. What was the reason behind this is that in 2020, most REIT managers announced that they were going to hold back dividends in the environment of uncertainty. So the capital amounts, capital depreciation was significant. However, it recovered very quickly the next year, and then have a look at in 2022, that was the beginning of higher interest rates on the back of high inflation. The income index capital decrease was 13%, whereas a total return fund came in with a capital decrease of 24%. So let's have a look at this averages from an average point of view, because this is a duration vehicle where you should be holding it for somewhere between 3 to 5 years. My view is that it should be the latter, as much as 5 years. And the average return of the income index, that is the capital growth, was 3.6%. It still exceeded US inflation, as against a total return fund that delivered 5%. Overall, the total return of the income index was just below 6.5%. Sorry, of the income index, yes, the total return of the income index was just below 6.5%, whereas the total return of a total return orientated index was 7.5%. So the difference was a credible 1% difference, but and as well, it's held its head above inflation. In the time being, you were getting a significant tick up in the dividend. Looking at this total return in a graphical way since 2015, already highlighted in 2020, most REIT managers held back their dividends and caused a significant drop in the capital values, but they recovered very quickly when some certainty started appearing, and overall the total return has exceeded inflation by a significant margin. So in summary, the key fund information, the JSE stock code is RWINC, and trading has already commenced. The market maker is Jane Street, arguably the most the largest independent market maker, and they wouldn't have taken on this ETF as a market maker if it didn't have adequate liquidity, a very, very important aspect in income investing. The index that it tracks starts with the name Reitway Global, as all our other customized indexes do. It is the Reitway Global Property Index, and it's administered by Prescient Fund Services, our partner, and we were the first white labeled ETF administered by Prescient, so the partnership goes back at least 3 years. The suggested investment environment is horizon is 3 to 5 years, and the distributions are quarterly at the calendar quarter, and you'll receive your dividend in your account approximately 10 days after each quarter end. If I can stop sharing there, and I can now address your questions that have been posted. The first one is, why do you not select 50 or 100 of the highest yielding REITs? It would just create too much volatility. And to that effect, I must just point out there's already a US ETF that tracks the highest 100 REITs, highest yielding REITs in the US. And it's delivering a really significant yield of 9.8% in US dollars, but it is extremely volatile. And as you can see, we are cautious on this volatility in our construction of our portfolio. And the next question that I have here is, would selecting 50 to 100 REITs with the lowest RSI, most oversold metrics, not provide better results? No, they wouldn't. Obviously, the higher yielding REITs produce a higher yield, These do produce a high yield, and in most cases, they are good quality REITs, acceptable quality REITs managed. It's just that their prices are reflecting an oversold, and we do need to use this as partly contributing to the better performance relative to the sector. So that is why, together with the highest yielding REITs, we have 40% holding to each of those in those three buckets, making up the highest yielding and the lowest RSRs. Another question, how did you arrive at the bucket allocation? And that is through extensive back testing with our colleagues and associates in Frankfurt, that is Selective, and Global Property Research in Amsterdam. And it was coincidentally that both of them ended up with 40%, and we wanted to have a reasonable amount allocated to the total return ETFs to ensure that we do not move too far away from the market. Finally, the fourth question, please may you provide us with a broad market update and outlook on global property. Well, for the past 20 years up until 2022, we've had a stellar performance. We had, of course, a significant pullback in 2008 and also the beginning of COVID. But ultimately, global property has been outperforming global equities for the last 25 years, excepting since the beginning of 2022. There was a significant decline on the back of inflation and the resultant higher interest rates. And the market declined significantly in 2022, and there has been a sideways movement up until now. However, during that period, REITs have continued to deliver higher than inflation increments in their earnings in the main. And we believe, and we've been saying for a long time now, perhaps too early, since the middle of 2023 and most of 2024, once the market starts recognizing it, that we expect a significant breakout from its current trend. That is the shortened version of it. Of course, I can keep you occupied for a very long time. However, when the sentiment is negative, it's an excellent time to enter in make an entry into a income ETF like this. If there's any other questions, I'll stay on for a short while, but thank you for attending. I don't see any more questions coming through. Thank you. We'll be closing the call.